Brought to you by ABSA, a member of Barclays, in association with Business Leadership South Africa.
Hello and a warm welcome to another episode of the National Development Plan, a plan in motion. I'm Nozipho, Mbanjwa. Now, the financial services sector has a key role to play in realizing the aims of the NDP, including business and infrastructure expansion, SME growth, job creation, and financial inclusion. On this episode, we'll be unpacking the theme, the role of financial services in the National Development Plan success to facilitate shared growth. And joining me to discuss this, I have Roy Havermann. He's the Chief Director responsible for financial markets and stability at the National Treasury of South Africa. Stephen van Coller, Chief Executive for Corporate and Investment Banking at Barclays Africa. Coovadia, the Managing Director of the Banking Association of South Africa. And Cecily Carmona, she's a Principal at A.T Kearney. We're also joined by our studio audience, and for you at home, if you want to be a part of this conversation, you can certainly do that. Join the discussion via Twitter. The hashtag is NDP410. Welcome, everyone. Thank you for making the time to join us. Roy, let's start off with perhaps what's really top of mind and fresh. And if we take a look at the Greek experience, one really begins to see the importance of the financial services sector in the economy. What lessons for South Africa in this regard?
Sure. The financial services sector, I think, plays a critical role in the South African economy. It's the way that people save and invest for their long-term investment needs. It provides important infrastructure funding and so forth. It also provides very important, I think, at the moment for South Africa, and I think that speaks directly to the NDP, is Outcome 6 speaks very clearly about the need for economic infrastructure. And I think particularly in that area, the financial services sector plays a very important role.
We certainly will get to economic infrastructure, as you highlight, a very critical area. But Stephen, let's get a sense from a player in the market and a leading player in the financial services sector. Is there buy-in into the National Development Plan, given the fact that there's been lots of negativity and pushback around the plan, and in particular, the ability to implement the plan?
I think there has been. What we're not seeing is a lot of coordinated engagement. So if you actually go and have a look underneath the lid of a lot of what corporate South Africa is doing, there is quite a lot going on. But we're not focusing on it, I think, together. And I don't think there's 100% cohesion or alignment on what are the key things that everyone can focus on. And it's one of the reasons why, you know, we as Barclays are involved, because we think as a large bank or as a large corporate, there's a lot more that we could do to try and galvanize big corporate in South Africa behind the NDP, which is a, you know, fantastic document. We think we're very privileged as a country to have a 30-year plan.
Is there space to play that role of coordinating, of galvanizing other corporate players to join you in trying to identify the key pillars and which ones should be prioritized as we move towards implementation? Do you get a sense that there's that opportunity to play that role?
Absolutely. If you have a look at quite a few of the large corporates, they'll have, you know, some kind of supply chain, SME, involvement training plan, but they're doing it on their own. And often the complaint we get is that they can do so much, but if there's not financial involvement, you can, you know, it sort of stunts the possibilities. And so we're doing a lot of what we call shared growth initiatives. We've just done something recently with Massmart where we've risk shared on them helping an SME entrepreneur start up a flour mill, and it's been a huge success, but only because we did it together, because we also can't manage all the risks.
Right.
But if you bring a corporate in, or sometimes government involved, you can then actually start managing all the risks around it and actually create something that's bigger. You sort of get to the 1 + 1 = 3. Instead of doing it on your own. And I think that's where we're seeing a lot of traction, especially from the large corporates.
Cass, I'm seeing you nodding at 1 + 1 = 3, so I'm not really sure about the mathematics there. But let me get your sense around beyond coordination and beyond making sure that we're all singing from the same hymn sheet. Are there other spaces where there could be closer collaboration between the sector and the drivers of the National Development Plan, in particular, if one considers the Planning Commission perhaps as one of the key players in this space?
Yeah, look, I think that firstly it is a good plan. I think that one of the things we need to do as a financial sector and business generally is not to wait for government or anybody else. I think that there's a hell of a lot that business can do itself. So let me, as an example, the Banking Association Board about a year ago agreed that we're going to look at infrastructure finance, SME development, and housing, and particularly looking at some of the spatial development issues. So those are our NDP priorities, which we were talking to our members about. What we're also doing, and I think this needs to happen at a couple of levels. The one is we can continue talking and debating about political will for this and all of those things. But I think where there is political will and an indication from a government that they want to actually work with us, I think we must work with them. So we have just signed an MOU with the Gauteng province, okay, on looking at infrastructure finance, SME development, particularly township economies and housing. And so I think we need to find those places where we can work government and business and make this thing happen, where business and business can work. So, and Coca-Cola, for instance, tells me that they're doing an amazing amount of work with women entrepreneurs.
Right.
And what I told them as well, if you're doing all of this work, then we should actually, at the banking sector, be working with you guys to see that if you're developing these women entrepreneurs, where can we come in as far as financing of these things goes? So it's those sorts of interactions that are necessary.
Let's take that example and perhaps extend it to you, Cecily, where we're saying there are corporate players in the space, there are fragmented initiatives, as was also described by Stephen. How do we close those gaps? How do we make sure that the financial services sector becomes the glue that moves a lot of these initiatives into a much broader, much higher impact outcomes that are aligned with what the objectives of the NDP are?
Well, I think that there are layers of involvement and layers of actioning the NDP. And when people say nothing has happened, the NDP hasn't been implemented, you just have to hear examples like this to realize that actually a lot is going on at the moment to forward the goals of the National Development Plan, both from the private sector side and from government side. And I think the trap that we get into is government kind of saying, well, private sector, just get on and do it. The plan is there. Get yourselves together and do it. And the private sector saying, we can't do anything until we have government commitment, until we have support for the goals. And one of the areas, for example, financial inclusion, so much work is being done on increasing the financial literacy of people in rural areas. Well, not only in rural areas, but of the unbanked population. And that's such a key enabler, and it's such a key part of the goals of the NDP, is to have people more financially literate so that they can protect themselves against potential risks in the future, and also increase the levels of savings and investment. So I think that, yes, coordination is key, but there's levels of involvement. It's at an individual corporate level, things are happening. But perhaps if there are ways as a sector or as an industry that we can work together better, the impact could be greater. And of course, working across sectors also has a greater impact.
I wanted to maybe take that point around financial inclusion and perhaps just peg it on to the conversation a little bit later and bring back infrastructure expansion that Roy raised earlier on. Yesterday, we woke up to the news that quarter-on-quarter GDP had contracted by a massive 1.3%. Is there an investment case for the financial services sector to step up when we're having such anemic economic growth in the economy?
I think there's a very important role for the financial services sector to help drive faster growth in this economy. I think one of the reasons why GDP growth was so slow and has slowed down is obviously the electricity constraint. And I think the private sector, and particularly the financial service sector, is really stepping up to the plate in terms of helping Eskom with its problems. So we have thought through this in I guess, 3 phases. The first is a short-term plan for Eskom, which is to recapitalize Eskom's balance sheet, so to sell non-strategic assets and to use that money to invest into Eskom. A medium-term plan, which is to ensure that we have sufficient generation capacity And in that case, I think, particularly on the medium term, if you look at what the banking industry has done, particularly the likes of Stephen, in terms of financing renewable energy, we can see that there's a lot more electricity coming on stream. And then the long-term plan is we need to have a look at the electricity market in a more holistic way and ensure that we deliver electricity over a longer period of time.
Stephen, I'm going to come to you in a second because I do want to get your comments on the REAP program and whether there are ways we could extrapolate lessons from that for other sectors. But Cass, let me quickly come to you and just get your views on the state of the economy as we see it right now and how the Banking Association views this and what this means for what the sector can do to try and galvanize towards the 5% that we're speaking about in the National Development Plan.
Well, we obviously extremely concerned. I mean, especially, you know, when our Reserve Bank makes a statement that they might intervene to prop up the rand. I mean, that's serious stuff, all right? So we extremely concerned about the economy. We would obviously want to play a critical role in generating economic growth, but the financial sector essentially is the oil that actually greases the engine of the economy. Now, if conditions do not persist for business to actually play the role it needs to play to grow this economy, then the volume of banking business goes down. Okay, and I think that what we need to do is we need to have. I think, you know, one of my issues with the National Development Plan, or not with the plan itself, is that we have a National Development Plan, but we don't seem to have a national agenda. And the national agenda right now should be to create the environment for business to do what it's good at, which is to do business in this country, to do business on the continent, and grow the economy. I think business needs to put on the table how it's going to grow this economy to make it an inclusive growth economy. And government needs to enable that. And so, you know, I know you're going to Stephen on the renewables, but we funded the renewables because it was packaged in a way that gave us the confidence to fund this. Okay? And that should be the template of which we should be looking at infrastructure programs. And we should learn from those lessons and replicate, not exactly, but at least have a checklist to say what was it in the renewable programs that gave investors the confidence to actually invest. And how do we then learn from that?
It's exactly the question that I was bringing to you, Stephen. What was the secret sauce? And can we pull out that secret sauce and put it in another pot and cook something else?
Interesting, I agree 100% with Kaz, is the sort of negative of the renewable programs. It took about 7 or 8 years to get going. The positive was there was good consultation, and so what came out was a framework that both international and local you know, corporates and financial institutions were very comfortable with. So it gave confidence. We knew what we were getting into. And if you've seen the speed with which it's rolled out post that, that's exactly why it's been able to, you know, happen so fast. So the process has been very transparent, it's been very inclusive, and everyone knows exactly what they're getting into, so you can manage the risks, you can package them up, you can do different things, and that's what makes the financing available, because a lot of these companies are, you know, as we call special purpose vehicles with lots of investors, so it's not like they've got this massive history. And to do what they've done, you have to actually be very open and transparent to create that confidence. So I think in anything, it doesn't have to even be infrastructure. If you want to create growth in tourism or growth in any industry, create that confidence, create that, you know, certainty. Otherwise, business doesn't want to come and invest long-term capital. You know, we get a lot of people investing in our financial markets, but they can get out very quickly.
Yes.
Whereas if you come in and you want to do a proper business investment, you need to know for the next 10 years what you're investing in, what's the environment going to be. And you know, that goes for any country, it's not just here.
Cecily, just perhaps to get us to wrap on this infrastructure part of the conversation, I mean, we've been trying to identify the secret sauce and what made the renewable energy project so successful. In your view, are there other low-hanging infrastructure opportunities that we should be looking at to say, if we could extrapolate the key lessons from what we've learned here, these are the other areas in an infrastructure space that if we had the financial services sector as well as industry players coming to the party, we could actually make more accelerated progress than we've seen thus far.
I think some of the secret to the success is the collaboration that occurred between government and between business and the financial services sector. So that kind of co-creation is one of the elements of the success. But you know, it goes beyond the economic infrastructure that's required. ICT infrastructure is also part of that economic infrastructure, which is so crucial to help the financial services sector to thrive and ultimately to help other sectors thrive. So that's another element. But I would also say that there's a social infrastructure element that is also required for the financial services sector to continue to grow and to play the part that it needs to in the economy. And that is about high quality higher education, ongoing development of skills, and a thriving labour market. Now, we also have to be realistic that the financial services sector is not going to create the 11 million new jobs that are required by the National Development Plan. But it is an enabler, and it can have a knock-on effect onto other industries, and that's so important.
Can I add to that? There's one thing that we talked about in the last session is sometimes there's this disconnect between policy and plan. And I'll give you an example. I was just reading about a few weekends ago about what happened in the farming industry where they set that minimum wage. The amount of farming labourers who've now lost their homes and lost their jobs because farmers have just said this is too difficult. So the minimum wage, fantastic idea, a lot of merit in it, but the result we got just hasn't gelled with what the outcome was meant to be. And I think in any of these things, if you don't gel what you want to get out with what you create a policy around, then you get this disconnect.
Are
and
we
I think
going
sometimes
back
they're done
to
separately.
Cass's call for an agenda? Is this what we're saying is missing? Almost a private sector-led agenda with the support of government. Is this what I'm hearing?
Well, I think what we need. I think we need to look at how we put regulation into place, and my view is that we need to move towards more sort of outcomes-based regulatory approach. Let's agree first what we want to do. Okay, let's agree that we want to create conditions in this country where workers are not exploited, and I think they're not exploited by and large. The minimum wage is a good idea, but let's look at different scenarios and see what is going to be the outcome of different scenarios. And let's agree on the outcome we want, and then regulate for that. Okay, so I think it's a different conversation.
Roy, you've got to come in the regulation conversation, because on the one hand, outcomes-based regulation. In the other hand, Cecily speaks about innovations, and if we look at examples on the continent where there's been massive innovations around the integration of mobile and banking, it's really because of a step back away from regulation. How do we take this conversation forward?
No, I agree with Cass. I think that that's why I think the NDP is such an important document, is because it says we have a joint vision between government and business about what we want to achieve. Now we need to have a conversation about how do we actually fit the policy and the outcomes together. So the renewables is a good example of how industry and government have worked together to create a regulatory framework that is allowed for the funding of renewables by banks. There are other examples, you know, the increasing competition that you're seeing in telecoms, the new entrance in fibre, for example, which shows that I think there is now an understanding from government's perspective that a lot can be done. And part of that is actually to reduce the regulatory burden. There's also been quite a successful presidential business working group, which has been working through quite a number of different regulatory areas. And just to flag which are the areas, because I think sometimes there's also a disconnect between government and business in terms of understanding from government's perspective what are the actual regulations that are the problem. And you might find sometimes it's a very small thing or something that government doesn't know about. And that's why you have to have a conversation, because you just have to put those things forward. And we have processes, we have put in place processes to deal with it.
Let's take the conversation to the small and medium-sized enterprises, and maybe even if we can pull the string of regulation in a little bit, Stephen. Does the regulatory environment allow the banking sector to adequately fund and support, lend to small and medium-sized enterprises?
Yes and no. Once again, I'll give you an example. You know, the National Credit Act, if you have a look at it just from a theoretical position, fantastic. You need it. But I had a case the other day where we had a small entrepreneur who had a home loan in his personal name but also had a business. And you can't disconnect the two theoretically, but we do for some reason. So he was behind on his home loan, so we weren't, it would have been reckless under the NCA to lend him money to his business, but he needs the money in his business to grow to pay his home loan back, because that's a source of income. He doesn't have a salary. And so then sometimes, you know, regulation, although it's good, does create some roadblocks, and it's those type of things we need to work through to see how do we enable that. You know, some of the capital regulations, the Basel regulations now, make it incredibly expensive to onboard, to do all the regulatory items you have to for a small client, because it costs X amount of money, and that X versus how much they're going to borrow is a big percentage of, and so you know, we need to work through that. I know in some of the regs we've now got some dispensations below 5,000 Rand, and those are very helpful regulations. And so I agree with Cass, some of our regulation needs to be backward looking, not forward looking, because otherwise it just creates too much friction in the system.
But surely, Cecily, microfinance should fill some of these spaces where we're trying to get the unbanked, to get them to get access to financial services and products. Has microfinance stepped up to that particular mandate, or is there still a gap that still needs to be dealt with?
I think that there's still a gap that needs to be dealt with. I mean, there's, you know, microfinance is not an affordable long-term solution for individuals. And the banks have taken really on the role of trying to look at ways of innovative ways of banking the unbanked and providing small loans to small and micro businesses, and bearing in mind that the small businesses in this country are really one-man shows, ultimately, one or two people businesses. So it's extremely small businesses, and of course there's the scale all the way up, but the majority of small businesses are tiny. So it is quite difficult to provide the kind of access to finance that they need at affordable rates in an accessible way. And that's what the banks are struggling with. And absolutely, while the regulatory framework is completely a requirement and has protected us in the past from some of the challenges of the global economic crisis, it still creates an added cost burden to the banks, which then have to be readjusted in order to be able to give affordable financing to small businesses.
How do we reduce the cost of lending to the poor?
Well, I think a lot has to do with issues related to risk and how we actually address that. And this is where I think how business and government works together actually comes in. So firstly, let's not knock ourselves too much. The reality is that for a developing country, we haven't done too bad as far as access to financial services goes. About 76 to 78% of bankable people are in the system, okay? Banks fund about 94% of SME financing in this country. So, you know, this usual refrain that banks don't fund SME is just not true. Okay, so that's a good story. I think what needs to be done, we've been saying this for a long time. Let's identify what the role of development finance institutions are. Instead of development finance institutions trying to compete with banks to lend, they should be doing the non-financial support, helping banks address some of those risk areas so that banks can actually lend. And it's those sorts of partnerships that we need, and it's that sort of an understanding that we need. Instead of saying, well, banks aren't lending to certain sectors of the community, so a state bank is going to do that. Well, a state bank will fail because it's the same. People can't pay the banks back because of certain risk area that we're not addressing. They're not going to pay the state bank back. So though it's not that simplistic solution, and that's where that discussion needs to happen.
Did you want to come
yes,
into this?
I just wanted to say the NDP also talks about, in relation to small businesses, it's not only about the financing, it's increasing advisory services to the small businesses so that they can actually grow their knowledge and expertise and skill, because that's where it falls down, is through the business planning process, robust kind of analysis on the cash flows of a business. So I think that kind of support that Cass is talking about from development finance institutions and other institutions to provide advisory services can help bring the SMEs to a level where it is easier for them to make access of the finance that exists in the bank.
Before we go to break, Stephen, let me get your comment in.
Yeah, just very quickly. The biggest issue you've got at that bottom end of the market is when they walk into a bank, they don't have this history. So if I walk in, I've got a history. But actually, the difference between them and me, as long as you give them the right amount, probably no different in risk, but I get charged X%, they get charged 3X%. So you have to address those two things. And I think there's a lot you can do to bring these development institutions, even government to a degree, and businesses together to manage that risk. So we've got this program where we've got these 8 enterprise development centers that do the training, the education with the loan, and you almost get this sort of stepped up. So you come in as a blue card holder and you get X amount, and if you pass 101, you can then become a silver holder and you can get 2. But that example I gave earlier, if the corporates come in as well and they can give operational training, suddenly you've taken another whole layer of risk out. If they come in and they're prepared to pay within 7 days, you've taken a whole lot of cost out, you've taken a whole payment risk out. So if you actually start unpacking these bits and working together, so going to my opening statement, you can actually fundamentally change the risk profile of these businesses, and that's what we have to get to.
On that note of fundamentally changing the risk profile by coming together and collaborating around services and products that are offered to small and medium-sized enterprises, let's take a short break. When we come back, we pick up the conversation with our panel, and then we go to our live audience who are going to be coming through with their insights and questions around this particular topic. Welcome back to the National Development Plan, a plan in motion. And we're discussing the role of financial services in the NDP success to facilitate shared growth. And still with me in studio, I have Roy Havermann. He's the Chief Director for Financial Markets and Stability at the National Treasury of South Africa. Stephen van Coller, the Chief Executive for Corporate and Investment Banking at Barclays Africa. Coovadia, the Managing Director of the Banking Association of South Africa. And Cecily Carmona, Principal at A.T Kearney. Now, just before we went to break, we're beginning to talk about the space, collaborative space where traditional banks, DFIs and other corporate players could come together to give a holistic product support to small and medium-sized enterprises. Let me come back and, Roy, get your sense around the new players on the blocks, like the formation of the BRICS Bank. Where do they fit into the puzzle, and how do they fundamentally improve the kind of collaboration between the sector and the NDP?
Well, I think the BRICS Bank will play a very important role in the long term. I think bringing in, particularly for African economic growth, the role of China will be quite crucial, and I think the BRICS Bank will play an important facilitation role between ourselves and the other members of BRICS. Just to pick up on the point earlier, I think it's at least from a Treasury perspective, it's really useful to think through the roles of government. And I think Cecily made a very important point about that the role of government is often not to actually provide the financing, but actually to provide other types of support. And that is essentially a much more cost-effective way for governments to get involved. And I think that is something that we can certainly take forward and think of.
Stephen, let's quickly go to the global monetary play. We've been seeing quite a bit of movement with China and their movements, and all eyes, of course, on the Fed in the US. Ultimately, this is going to have an impact at a consumer level in South Africa. How does it impact on the kind of product and service that the ordinary consumer can access from a Barclays?
Well, there's sort of two things. One is, I think you're alluding to rising interest rates. I think at this end of the market, a 1 or 2% hike doesn't make a difference to a 30 or 40% interest loan. The real thing you have to do is reduce that cost. and that's really where the effect comes in. I think for me the worrying bit is that as the economies slow down, it's that bottom end that really struggles the most, because big players have got some runway on their balance sheets, and so what typically happens is that banks' lending criteria get tightened, and that makes life difficult. So the thing here, I think what's really important is going back to the earlier points, is that in times like these, you've got to increase the education, you've got to increase the vigilance, you've got to increase the cooperation to reduce risk around anything you do. So we're driving very hard in terms of what we call this shared growth initiative, is really trying to bring parties together who have an interest in the outcome, because then together you can manage that risk and fundamentally change the basis of why you lending money to people, and I think that's going to be a critical way forward.
I think on that note, where Stephen speaks of in times like these, definitely indicating that it is not quite business as usual for the sector or for the implementation of the National Development Plan. Let's invite our studio audience to participate in our discussion. Ladies and gentlemen, welcome once again. Please do go ahead with your questions. Kindly just stand, introduce yourself, and indicate to whom you'd like to pose your question. Ma'am, please go ahead.
Hi, Renee. From what Stephen has said, absolutely, it makes it very difficult for the banks to lend money to people with no track record. One of the most important things as well is that we actually need to, there's 60% of our people are unbanked, and it makes it very difficult for them to actually transact. So I've been involved over the last year in rolling out a mobile payment platform that's bank neutral, network neutral, which allows people to open a wallet and actually go and deposit money in any bank and withdraw it anywhere. And it's actually enabled, in the spaces where we've worked, enabled transactions and commerce to start happening a lot easier, because it's very difficult for people to always have to go and draw cash and operate on that manner. It also starts giving us, as a broader perspective, exactly what's going on in that market. But it operates on a fixed basis, so it's less expensive for people, and the money is available to them. But what it also does is it gives you a track record of their spending. So your traditional cash or wage earner you can now start getting a track record, so that when he gets to a point, or the business gets to a point where they need to borrow money, that's available. But I think that we need to make it more just the operational and be able to transact with one another. We need to make that easier in that market.
So one of the things that I'm also picking up there, going back to that conversation, Stephen, the cost of verifying creditworthiness is quite high. But technology, Cecily, has it bridged that gap? And I'm going to ask you to just reflect on that as we go back to the audience for more questions. But I think, thank you for that, Renee. Interesting insights there in terms of what you're doing in that space. Yes, please, sir.
It's Andy Letloile from Infocom. My question is to you, Turo. These bottlenecks that have been identified here from regulatory point of view, we know in South Africa that whatever you do, one size fits all won't work. From an NDP point of view, is there a case for Treasury to identify or accept that business or entrepreneurs like myself can come to Treasury and say, I believe this is an NDP priority program. Can these bottlenecks be, or can I be exempted from these bottlenecks? The same way as the SEZ, except now it's not tied into specific location. And I'll give you an example. If I find that in this particular program, it fits all the requirements, priorities of the NDP, creates jobs, long-term, it's fundable, but I have issues around maybe labor, I know it's controversial. I've got issues about some, imports and all those things, but I've modeled this, and I come to Treasury and say, for this program, I want you to reduce certain things. Is there a case for that? Because then you can literally grease out the bottlenecks that are likely to take 10, 20 years to change, and at least give me permission to implement. I don't know if that makes sense.
Considerations there for reviewing your mandate and seeing that whether you can play a greasing role in sort of reducing some of the bottlenecks. But let's allow you to reflect on that. There's a question at the back, so if we get the microphone very quickly to the back. Thank you so much. Please do go ahead.
My name is Muiponi Lopang. I'm the MD of Stanlib in Botswana. I just wanted to highlight, I think, an important stakeholder that I believe can participate and perhaps hasn't been represented in our discussion so far. The asset management industry, I think, is a critical partner in achieving the development aims as well as the growth aims of any government, really. Stanlib is represented in 10 countries in Africa and are growing. We've identified infrastructure, private equity, and property as key investment areas that provide a great intersection between achieving government and general citizenry's aims of developing, while also generating attractive returns for those people who've invested in those opportunities. As I said, we control a significant portion of assets, not just Stanlib, but of course asset management industry as a whole. And in our experience, we closed earlier this year our first infrastructure fund, opportunities mainly in South Africa, and we found that in fact there's no shortage of investors wanting to participate. We'd underestimated the demand and now have to expedite our second fund. We've been successful with property funds. We're launching the first REIT in Kenya, and again there's demand both on the continent, and we're also able to attract investment from offshore to come and invest in this. So I think asset management has a crucial role to play. And as Cass said, it's important for us to lead these developments and to partner with government. We have the skill and the expertise to package these things in such a way that they are attractive and it's easy to generate investment.
Moiponela, thank you for that comment. So let's maybe get a quick reaction from this first round, and we'll come back perhaps for a second round of questions. Cecily, let's go back to the issues that Renee raised. A bit of a conflict in statistics. Renee saying 60% is unbanked, Cass telling us that we're doing quite well. Let me allow you to play the referee and give us a sense of how do we interpret this?
I think it's the definition of what unbanked is. So traditionally, unbanked means no access to traditional financial services, i.e. a bank, but we find many informal savings schemes and many informal transaction type of activities that happen, which increases the stats to much more of what Cass was mentioning. Technology is playing an important role. Moving towards digital banking, digital platforms, much more mobile access, and particularly the role that mobiles are playing is really important in the access game of financial services, and also potentially in costs, although that may not be seen in having an immediate effect. But you also have to realize that there's a difference between the transactional banking, which is payments in and out, and a more kind of full financial service, which is moving into the loan space and credit, where it becomes a lot more complicated to serve. I think that the point was interesting about creating a transaction history, and that certainly can play a role, but at the moment the credit models look at different aspects over and above just the transaction activity.
And Stephen, yes, I'd like to get your insight in that.
I just want to add to that, because I do think that we're entering into an era with just the cost of mobile technology, the cost of technology and the performance of it is just exponentially changing. I mean, your iPhone that you've got today has got more information, access to more information than Bill Clinton had when he was the US president. But
explains some decisions.
Yeah, but there's, just to give you an example, there's a company in Kenya called Mbanjwa who will give you short-term loans. So it's almost like intra-payday loans by going onto your cell phone and taking information off the cell phone. And there was an article the other day, they found things like if you're a person that phones more than you receive calls, you're more likely to repay than the person who phones less but receives. So they've got 33 things that they're working on, points that they then give you a credit scoring. So going back to the point that was made earlier, is that you can very quickly then get a credit scoring of someone because all your information is now getting stored in a place. And that's what banks have to move to, or any financial institution. If you can start gathering this this data, which means a fundamental change in your systems that were very old, and you need to go and have a look at these new points. And if you think they're predicting there's going to be 1 billion smartphones in Africa, I think by 2020, and they cost now $40, they'll probably, they're predicting that by 2030 you'll get them in a Rice Krispie box, they'll be so cheap. But we have to start moving to that if we want to solve this financial inclusion.
So really interesting insights around reviewing the lending models to accommodate the way we're consuming financial services and products. Roy, your mandate, the ability for entrepreneurs to come and request for bottlenecks and exemptions, bottlenecks to be unlocked and exemptions to be applied. How do you approach that kind of conversation?
Well, fortunately, most of those things aren't in the Treasury's mandate. Some other government departments perhaps to talk to. But I think that it's a very important point in terms of the process, and maybe this is something to throw back to business, is to what extent when business engages with government, do they take into account the concerns of small and medium enterprises, and how is it articulated to business? Because I really think that SMEs are the dynamic growth engine of this economy going forward, and we really need to unlock how do we have those conversations with small enterprises to ensure we have their views.
I think Andele's point is so important, and Andele, I think we'll get back to it if we have time, because I think it goes back to what Stephen raised very earlier on. In a fragmented approach, we will always have these kind of problems where bottlenecks will exist. But Cass, I want you to comment on Moiponelo's contribution around the asset management space taking a leadership role, especially when you look at infrastructure expansion. Why are we not seeing that kind of conviction in the market?
Okay, I think it's an important point, and there is that sort of conviction in the market. The association that represents asset managers, the Association of Savings and Investment in South Africa, and the Banking Association are currently, as late as yesterday, working very closely together in interacting with government on the infrastructure program. So we are telling government that banks have certain expertise, like transaction advisors and others, people who can structure projects. The fund managers and others have longer term funding. And our discussion with government at the moment is that we should be talking so that we actually put together the total funding plan. So banks usually fund during the construction phase, first 9 years or so, and then taken out by the longer term funders. And we're putting all of that on the table at the moment. So the fund managers and banks through their respective associations are working very closely together. Our view is that we need to provide to government a total funding package for the duration of the project. And that's how we're interacting with the government. So they're a crucial player, and certainly in the sub-projects that government have put on the table, we're working together.
So the syndications are hard at work. So let's get back to the audience. Let's get a sense of another question. We'll take the gentleman, we'll take the lady towards the back, and we'll take you. So if you've got the microphone, please go ahead.
Hi, Jaco Brahane from African Leadership Network. This question is for Stephen. With the recent uptick in the volatility in the rand and the global sell-off, particularly China, how do you see the private sector adapting, to respond so that the South African organic growth is ensured as well as FDI?
Thank you very much. Nice big question for you, Stephen. Let's get the gentleman in the front, sir. Please go ahead.
My name is Mark Leistner of the European Investment Bank, EIB. I have a question on entrepreneurial spirit. Cecily, you referred to the importance of education and of skills of advisory. I think the entrepreneurial spirit is not necessarily related to either of those. And it's sometimes said that entrepreneurial spirit in South Africa is lacking. It's also sometimes said that the private sector has a negative image. I'm wondering whether the two things, if they are both true, are related. And I'd be interested to know, what are the reasons, do you think, if it's true, for a lack of entrepreneurial spirit? And more importantly, what can be done to improve it, both by the private sector and by the public sector?
Thank you very much. Fantastic question. Let's get the lady towards the back, please. Yes, please, ma'am.
Hi, I'm Nava from Delbert Global Development Advisors, and my question is for Stephen. Your comment about how we're using technology to realize and unlock alternative credit scoring methods really struck a chord, and it's a lot of the work that we're doing currently. And I know that Barclays recently purchased Rainfin, which is a peer-to-peer lending platform. So it's really showing the innovation in that space. However, there's a lot of criticism that the banks often cannot catch up with innovation as fast because there's a lot of regulatory background to it. What is the role of the banking sector in being able to keep up with the fast-moving pace of the technology sector currently?
Thank you very much for that. So quite a number of questions at your door, Stephen, so maybe let's give you a chance to get a stab at them. First, there was the one from Jaco with regards to the global sell-off and the meaning of that for us.
Yeah, well, I think when you get into volatile markets like we've got now, and especially when you've got a volatile rand, and if you're an importer or exporter, you know, my advice generally to my clients is, you know, keep it simple. In these times, you need business flexibility because they're not only bad times, because these volatile times, there's always opportunity. And if you haven't created flexibility in your business, you can never actually persecute them. And so I would say for, you know, any business, make sure you've got flexibility and not overstretching yourself, because the opportunities come, you want to get involved in them. On the second question, it's a very interesting question, and it's one that big organizations struggle with. But I think if you have a look at what banks are doing, and I can talk, you know, particularly about Barclays, is this pace of change is so fast at the moment that we are almost being forced to get involved. So we actually spend money on innovation hubs, fintech, you know, doing accelerators, doing just programs where we can get people to come and, you know, hackathons as we call them, come up with ideas and try and fund them. So we actually are spending quite a lot of money. We've just opened a hub here in Joburg. We're busy opening one in Cape Town. There'll be one in Kenya, etc. We've got one in New York. We've got one in London. We've got two in London. And really trying to access these entrepreneurs and see what parts of those businesses we can use. So that Rainfin example, we bought into it because we needed to pay school fees. And we've learned an enormous amount by dealing now with that company and actually finding out that what we bought into, there was 10 other things we could do with it. And so I think there's a huge opportunity for, you know, big corporates to actually spend not lots of money. Actually, it's very big for that sector, but not a lot of money to actually try and invigorate. Because going back to what we heard earlier, is this entrepreneurial SME sector is really going to be the driver of growth in these difficult times, because we need to fundamentally change the way we do a lot of things. And if you don't help that or seed it, or if I can put it that way, we're just slowing down that process. So I think it's almost an obligation.
It's almost an obligation, I think, leads directly to the question that was put to you, Cecily, around an entrepreneurial spirit.
I don't think we're lacking the entrepreneurial spirit. I think what we're lacking is the process after the spirit. So it's the optimization of that entrepreneurial energy to make it a reality. It's a process of innovation, funneling, going through certain hoops, as I spoke about earlier, the skills and capability to put the idea to reality. And I think that's where we fall down time and time again, not only in the entrepreneurial sector, but also in something like the NDP, which is now, you know, a great plan and lots of activity happening around it. But this kind of process of implementation seems to be what falls down. Just one comment on the private sector. If you ask the private sector, I don't think that they think they have a bad reputation. But again, you know, we have been able to be a productive nation because our costs of input have been low. Our costs of infrastructure and costs of labor have been low, and if productivity is a factor of the input costs and time, we've been able to be competitive. But as our input costs increase, labor and infrastructure, we become less productive. So I think it links to the question about entrepreneurship, is that there's this kind of process optimization, efficiency enhancement, and the banks are certainly right up there. There's a lot more that can be done in enhancing the efficiencies of banks. I know that they're already doing a lot, but more that can be done.
Can I just add to that? I think sometimes we feel that we don't have the entrepreneurial spirit, because we create a situation where we think that everybody can be an entrepreneur. And we look at entrepreneurial development as a proxy for job creation. And that's wrong. Entrepreneurship is hard. Okay? And everybody is not going to be an entrepreneur. We've got to identify those people who have the capability, who have the spirit, and promote them. And we've got to grow the economy so that others can get jobs. And that's what we've got to do.
Unfortunately, we've come to the end of the show, but I think on that point of entrepreneurship being hard, and that we need to collectively and through a collaboration work on supporting them, promoting them, and dare I add, lending to them, I think the country might be able to meet some of the objectives outlined in the National Development Plan. Thank you so much for making the time to join us. And of course, a big thank you to my panelists who took their time out to share their insights today. That's Roy Havermann, Chief Director for Financial Markets and Stability at the National Treasury of South Africa; Stephen van Coller, Chief Executive for the Corporate and Investment Banking at Barclays Africa; Coovadia, Managing Director of the Banking Association of South Africa; and of course Cecily Carmona, Principal at A.T Kearney. Thank you for making the time to join us. Remember to keep the conversation alive on Twitter. The hashtag is NDP410. Until next time, it's goodbye.
Brought to you by ABSA, a member of Barclays, in association with Business Leadership South Africa.